Hey guys, Dilleen here. I want to do a video about just giving everybody an update about what's been going on the last 6 months and what I've been doing personally, also business-wise, and also what's been happening in the property market, basically. Thought I'd do this video while I'm driving. Got the camera up on the mount, so it's all good. But basically, it's October 21 right now. I haven't done videos in a very long time, very long time. I just haven't made the time, unfortunately, and I've been focused on other things such as business and building property portfolio. But it's October 21. The market has gone nuts the last 6 months. If anyone remembers the video that I did, and if you haven't seen it, go back and watch it. But literally, at the beginning of COVID, I said the market was going to go through a huge growth cycle. I've been saying this for a while, especially in markets like Brisbane and Adelaide that have always been really affordable. Since interest rates dropped and the affordability, like those areas that were affordable, that were 300, 400, 500, 600k properties, like they became even more available to everyday Australians and property investors as well to buy, because the repayments have gone down significantly as interest rates have dropped the last few years. But the market's just gone nuts, especially like all throughout Australia. Markets are increasing. Different states are still recording record growth at the moment. October 21. Brisbane's gone up. Like some of the locations that we've been buying, some of the suburbs, some of the pockets, some of the areas, even since last year, like some of the swing in the prices have been like 30%, 25%, 40%. Like there's a lot of clients last year that we picked up houses as an example. James, as an example, I texted him one of the clients, I won't say his last name for confidentiality reasons, but he bought like 3 properties last year. One of them was a house. It's a 4-bed, 2-bar, 2-car house, about half an hour from Brisbane CBD. Bought it for like 288,000. Like those properties now are going for like 440, 450. Like in terms of like it's gone up like 60, 70% in 12 months. Now that's one example. That's one example, but that property was bought at 288. It was probably worth 320, 330 at the time. So like obviously we picked it up a good 10, 20% under what it was worth. Then the market jumped 20%. So that's what I mean when I talk about sourcing those properties that you get 10, 20% under market value. When the market does shift an extra 15, 20% like we've seen in 12 months, 18 months, if it shifts 20% and you bought 20% under what it was really worth ultimately, then you picked up 40% a swing in 12 months. I bought a property as an example as well, right? Last year, literally 14 months ago, right? I bought a property. It was a 2-bedroom, low-set townhouse, 25 minutes, half an hour from Brisbane CBD. I showed this property as well to like 6, 7 clients. They all said no last year. They all said no, unfortunately for them. They said no. One of the reasons was, oh, it's a cheaper property. It's 130 grand, Eddie. I don't think this has good capital growth. It looks like it needs to have a little bit of work done. I might have to spend 3, 4, 5 grand on it. I don't want to spend that money, etc. A lot of like all the excuses that I've heard. And while I don't force people to buy properties, I provide them the amazing opportunities. But that property was 133 grand, and one just sold next door for 230. And I got it valued by the bank at like 230, 240 recently. I pulled equity out of it, but that in a percentage value, like 130,000 up to 230, 240 in 12 to 14 months. Like that's 50%, 60%, 70% growth, like overall price value swing in 12 months. The property's almost doubled in 12 to 16 months. Like that's unheard of. You can't do that. Like no property investor does that. Not to mention that one as well had it was running for $280 a week. But it's funny, like a lot of people just don't see it the way. they've listened to too many podcasts, that they're too analytical about what properties to buy, what areas to buy, what suburbs to buy, and they miss out on amazing opportunities every day. But yeah, a little bit about the market. It's gone up a lot. I see it in the future. If you haven't bought, you haven't missed the boat. Like, you can never think you've missed the boat. The property market, it's always going to be a good, like, real estate in general is always going to be a good thing to invest in compared to like stocks and crypto and shares and all that other kind of stuff. Like residential, like real estate, one of the safest asset classes and things to buy. You can do as little as 5% deposit. You can leverage your capital. You know, buying we've got a client that I'm about to call in a second. They're going to buy a property for $260,000. Now, if they do a 5% deposit, that's 13 grand. Now, if they do 10%, it's 26 grand. Like, you can get into the property market with a decent, like, small starting point. Anyone can do this. You can be 19 years old, buying your first property. You can be 20, you can be 40, you can be 50. Like, anybody can get in the property market now. It's actually, right now, it's easier than ever to invest in property. You can get started with as little as 30 grand, 35 grand. Yeah, like the Brisbane as well. Obviously, the games are coming to Brisbane 2032. I forecast the next 2 to 3 years of Brisbane to have explosion of growth as it has the last 12 months. I do not see it slowing down at all. It's still one of the most affordable locations in Australia, which is a capital city. Like, so as an example, you can pick up, I've got another client right now that's buying a house, good solid, 4-bed, 2-bath, 2-car garage, 600 square meter block, like 370,000. And we're like 25 minutes drive, 24 Ks roughly to the Brisbane CBD. Now, 370,000 for a house and land on a big block of land, good quality house. You get like $420 a week rent, so it's about a 6% yield roughly. You can barely buy properties in regional areas for 375 grand for a house. But here we are in 2021 October, though these properties are not going to be around for long. Like, especially under 400. Like, I was picking up I had some clients buy houses last year for 250, 260, 270, 220. You know, those properties are not here, and those prices are not here anymore. You can still pick them up in the 300s, houses. You can still pick up good quality townhouses, depending on obviously how modern it is, how old it is, etc. For low 200s, mid 200s. You can still pick up units and villas and things like that in Brisbane within half an hour of, you know, like for under 200,000. Those are very, very rare at the moment, but they're really good opportunities. So, yeah, there's property still out there. Yeah, I thought I'd give you an update about the property market and what I've been doing. What I've been doing as well to finish it off. I have personally grown my portfolio a lot the last 12 to 24 months. Now, in terms of total property portfolio value, I'm almost hitting 15 million worth of property that I'm holding, with a few settlements that are properties that I'm buying at the moment, some bigger stuff that I don't usually buy. Once they finalize, once they all go through, of probably just under about 15 million worth of property. Now, I'm 30 years old. You don't have to be, you know, young to do, like, you can be older to obviously buy property. I've been fortunate and thankful to be obsessed with property from a very young age of, 16 years old. I grew up in housing commission. No one in my family owned a property at all. I grew up probably the poorest circumstances out of any property investor out there. Every other mainstream property investor that you see on TV, I can guarantee you they did not grow up as poor as I did. I grew up in the very most humblest of beginnings compared to any other property investor. But here I am, 30 years old, almost 15 million worth of property in my portfolio. My goal moving forward, and goals change, right? Like, goals change all the time. I never thought in my wildest dreams 15 years ago that I'd have 15 million worth of property by the time I'm 30. I just turned 30, but I do. So even as an example, my next goal is to hit 100 million worth of property in my portfolio, but I'm sure once I hit that, it'll change again. But these might seem like big numbers, they might seem like small numbers to people, but it wasn't too long ago when I was first trying to hit my first million worth of property, 2 million, 3 million, 4 million, 5 million. Like, it's property investing is a snowball. It can be a snowball effect if you play your cards right and you invest with the right strategy. To me, the right strategy is trying to buy existing metro location properties that are below market value, below available properties on the market, that you're buying into in a growth cycle in that capital city that's on a growth cycle swing. Not to mention, it needs to have good cash flow, which can't be underestimated. Cash flow is very important for servicing, and it's got to have good capital growth. Like, you've got to buy in the right locations, the right capital city at the right time. It's all about time. Timing is a big thing. Time in the market's more important, obviously, but you've got to have the right strategy. So if you're just starting out, look at how some tips that I can give you. Look at what capital that you can what capital savings that you can accumulate now. And realistically, like, if you buy a property tomorrow for $350 as an example, you can start small. You don't have to buy in the state you live in necessarily. If you live in Melbourne, you don't have to buy in Melbourne. If you're buying an investment property, you can buy in other states. Like, I now own properties in Sydney that are almost worth 2 million for just one of them. I own another property in Sydney that I bought like a year and a half ago for 740. I just got it valued at like 1.2 mil. So I've diversified my portfolio, with the capital of each different states. Like, I've got a bunch of properties in Adelaide, a shitload of properties in Queensland as well, but some big fundamental ones in Sydney as well. So at the moment, I'm also buying some commercial property, like commercial / residential at the moment. I just also bought personally 12 acres of property in Queensland, in Brisbane, about 25 minutes to Brisbane. I picked up a property at auction. It was a steal. I paid $810,000 for that property. It's 11 and a half acres, almost 12 acres, which is a lot of land. It's got one house on it. It's a little bit different to what I usually be buying. And now, look, not every investor can get started with buying. These are some examples of ones that I've personally been buying, but clients out there, people watching this video, I've got myself to a different position than I used to be in. So now, obviously, I've got different risk appetite. I can buy stuff that's maybe a little bit negative in terms of cash flow, because my other properties can self-sustain themselves and provide cash flow for others. So I can grow my portfolio in different ways and add different asset classes, different types of property with different attributes to my portfolio. So as an example, the acreage that I just bought, it's about to settle. It's a big house, 11 and a half acres, sorry, 810,000. Now that house, once the owner gets out of it, eventually, within the next month or two, that'll only rent out for like $600 a week, $550, $600 a week. Now, in terms of rental yield, to me, it's not good. Like, it's not as good as what usually kind of rental yield, but the upside is it's a lot of land. I expect that land within the next, 7 years as an example, I'll probably be able to double my money on it, and it'll probably be worth 1.6. It's got different opportunities where I can subdivide the front blocks. I can put a lot of houses on it. I can just subdivide, and land in that area is going for like 250, 300,000, 250,000 for just 400 square meter blocks. So I've got a lot of acreage there that I can subdivide. So I could double, quadruple my money. in 7 to 10 years. It's a long-term play. However, in the downside, in the short term, I've obviously got a cash flow. It doesn't cash flow itself. So would I do that? And should you do that if you're starting out? In my opinion, no. You shouldn't start off with something like that. If the average person went out and did that with not much, savings, or their borrowing capacity wasn't crash hot, then they would be stuck. Like they're putting all their eggs in one basket when they're buying something for 810, and they've got to do 20% deposit, 15% deposit, whatever it is, 10% deposit on it. Then they've got to, if they do decide to subdivide it, they've got to pay a shitload in subdivision. They've got to put time and effort, and they're holding a negative asset. So like, I can do it now. Would I do this a year ago? Would I do it 2 years ago, 3 years ago, 4 years ago, when I had a lot less properties, when I didn't have the cash flow that I do now coming in? No, I wouldn't do it. So yeah, you build your portfolio in different stages. I truly believe. If I was starting again, I would get started with something small. I love small properties as well. As I said, I bought that property last year for 130 grand because no one else would buy it, and I knew it was a really good deal. So yeah, I buy small properties, I buy big properties. I'm buying another commercial one at the moment. Probably it's just be about $1 million, be about 980 roughly, or about $1 million. That's a commercial property down the bottom. It's a residential property up the top. You could probably get about $1,400 to $1,500 a week for it, so about 75 grand a year in rental income, and I'll get it for about 950. So it's a good solid return. Yeah. So finance, a question that you guys might have is like, how the hell are you financing this stuff? Like, how do you do it? Everyone always asks me that question. What bank do you use? You got to have a strategic formula. Like it's very hard to explain, but to get the first, like, I say this to clients. Now, I'm not a mortgage broker, but I've got a lot of experience with getting finance. Like, I know how to get finance, and I understand mortgage broking very in depth compared to a lot of other investors, and how banking systems work, because I've done personal research, personal education on it. But if you're starting out, let's say you've got one property or two properties as an example. Let's say that you go to the bank and you want to buy property number 3. I'm just going to throw this example out. Let's say you go to Commonwealth Bank, and Commonwealth Bank say, Eddie, you can borrow $700,000. So what I thought in the beginning is, when I went to the, what you might be thinking is, I can only borrow $700,000 worth of property. But to me, when you go to one bank and you have, let's say, 2 or 3 or maybe 4 more properties or whatever it is, and they give you your borrowing capacity, my suggestion is to take what they say with a grain of salt, because that's just one bank, and different banks have different policies. And if you have a borrowing capacity with Commonwealth Bank, let's say it's at 700K or less, that doesn't mean that you can only borrow $700,000 worth of property, right? Now, you might have to watch the video again or watch some other ones, but it's very hard to understand. That's one bank. You might borrow, it depends. When a bank services your loan, when a bank does your servicing, your borrowing capacity, they'll look at your situation right now, and they'll take in the rental income of the property that you might buy, that you're planning to buy. So they take a rough rental income, and different banks, as an example, sometimes they only take 80% of the rental income. Sometimes other banks only take 75% of the rental income. Sometimes only take up to 6% rental yield. But so a few people work at a bank might be like, well, my bank only takes this, but there's 100 different banks out there. There's a lot of banks. There's a lot of lenders and financial institutions that lend money. So they all have different borrowing capacity. So if you're speaking from one bank, that's just one bank. So when they look at your situation, long story short, let's say your borrowing capacity is 700,000 and you buy a property for 400, right? A lot of people think, well, I've only got 300 left to buy I've only got my borrowing capacity, I can only borrow 300K more. But as part of the 3-step formula that I've adapted and built over the years, if you buy properties with good cash flow, if the good cash flow to me is 5%, 6%, 7%, 8% yield, higher the better. But the higher the more yield that you can have on your overall gross portfolio, the more you're going to be able to stretch that borrowing power. So if you buy a property for 400 and your borrowing capacity originally was 700 with CBA, but if that 400k property, maybe let's say it rents out for 550 a week, now that's a good yield. Maybe it's a 6.5-7% yield off the top of my head. Don't have a calculator, but 400k purchase, 550 rent, maybe 600 rent. Now, very hard to find those properties, but they are out there. They might not be where you live, they might not be where you know, but if you get a good yield like that, when you go back to the bank the next time, your borrowing capacity ultimately won't have gone down that much. You won't just have 300k left. It might have only gone down from 700 to 600 or 700 to 650. But eventually it does go down with that one bank. But what you can do then is go to a different bank. And different banks have different borrowing. So a lot of lenders start with the big banks as an example. The main lenders, CBA, the Westpac, the St. George, etc., etc. Then they go to the second tier, then they get knocked back from the first, knocked back from the second, and eventually they'll fall up on the third. And they'll end up with the Pepper Home Loans, the La Trobe Financial, the Liberty, the Granite, all that kind of stuff. So you can stretch your borrowing capacity. No financial advice, I'm not giving you financial advice, but I've been able to stretch my borrowing power. Obviously, the higher income that you make and that you can get yourself on, and I work 3 jobs at once to increase my borrowing power. So you can do that, but you got to be realistic as well. If you're on, minimal wage, you got to get that wage up as time goes on. You've got to, whether you do a side hustle, whether you get a second job, whether you get a third job, whatever it is, that's the realistic point of it as well. But you can stretch your borrowing power. Not to mention, in terms of investors out there watching this video, or maybe you don't have a borrowing power in your individual name. Maybe you've got 4 or 5 properties and you're stuck temporarily. Well then, another tip for investors out there that people want to buy property is that you can buy property in a self-managed super fund. And you can put down as little as 20% deposit. And with it, your borrowing capacity in a self-managed super fund is different. It's different to your individual borrowing power. So there's been times in the past where I was stuck with my personal borrowing capacity. The bank said, "Get lost, Eddie, you can't borrow anything." They said, go away, you're trying to buy too many properties at once. Then I thought about it, researched, a lot of research, and it was just drive. I then realized that I had about 50k roughly in super lying around, and I could use that to buy a property. So I rolled it over to a self-managed super fund, and I could still borrow financially in the self-managed super fund based on the super contributions per year. So there's another tip. But I hope this video helps. I wanted to give you a quick update as I was driving. Thanks for watching, guys. If you have any questions, put them at the comment section below. Smash the like button, please. Share this video. If you have any questions or videos that you want me to do, put them below. And thanks for watching, and I look forward to chatting to you guys soon. Bye for now. Bye.